Good morning and a very warm welcome to you all. I'm John Lovell, Managing Director of Capital Allowances specialist firm, Lovell Consulting. I will be joined this morning by my colleague Richard Massingham. Richard has similar background to myself. I've been doing capital allowances for 30 years now and have a background as a quantity surveyor. And I also worked and trained in tax with one of the large accounting firms. Richard has a similar background, albeit he's younger and better looking than me, and he's had time to get a haircut. We will be issuing CPD certificates to anybody that would like one, and feel free during the webinar or afterwards to post any questions. The questions will be completely anonymous. Your identity will not be shown, and we will in any case be sending up a follow-up email to everybody with any questions and answer responses. So let's make a start. We've got a good level of attendance to this webinar. We had something like 400 acceptances. And if anybody, again, would like a copy of this webinar or the slides, send an email and we will issue those. So we'll be talking for just under an hour, predominantly about the super capital allowances. And fresh on the back of the Chancellor's success with Eat Out to Help Out, he kind of his budget that he launched in the beginning of March was termed Splash Out to Help Out, with the splashing out being through relatively large capital allowances, the super capital allowances, though some people have critiqued it and said they are super complicated. Hopefully, if you listen to this webinar, we will try and make them as simple as possible based on practical case studies and our day-to-day practical experience. So let's make a start. You can see we are big fans of Mr. Sunak. The ladies in the office refer to him as Dishy Rishi, and the guys in the office, they like him now because they can call themselves super capital allowances specialists. And it was good news, and I think was completely unexpected, even to capital allowances specialists. There hadn't really been leaks to my knowledge. And the good news was, in certain circumstances, there are now 130% super capital allowances for general pool plant and machinery. And we will be explaining what general pool plant is. It's not all plant and machinery, it's just general pool. And clearly you can now get more capital allowances than you've actually spent, and all of those allowances can be available in the first year. For other types of plant and machinery, which typically have a longer life, things like lifts, escalators, heating, these are integral features, and you will now get 50% write-off in the first year for these integral features. So you won't get more capital allowances than you did before, you'll just get the tax relief faster. The other positive thing in the budget was losses historically have been only been able to be carried back for 1 year, but they have extended that to a 3-year carryback, which is good news for trading businesses. The losses in the first year are completely uncapped in terms of the value of losses that can be carried back, but in years 2 and 3, they are capped to 2 million in each year. And the other positive, which had been quite widely expected, was the introduction of 8 new free ports. And my colleague Richard will take us through some of those benefits. As you can see from this slide, there is a substantial cost to the Treasury by these new generous capital allowances, something in the order of £29 billion. So substantial cost to the Treasury, and the Chancellor is quite proud of this tax initiative. He's been doing his own videos. You've probably seen some of them on LinkedIn and other social media forums. And even today, one of the financial journalists in the Daily Telegraph had a whole article about a super capital allowances-led recovery. So the intention is to get companies to splash out, to invest in plants and machinery to help recover the UK economy. That is the plan. That's the strategy. In the short term, a substantial cost, but clearly the intention is an investment-led recovery. The extension of carryback of losses has a more modest cost. It's more in the order of £1 billion, so much more modest compared with the super capital allowances. Some of the less positive news, here we have Boris, Mr. Corona, is unfortunately it was a policy decision that these super capital allowances will only benefit companies. So they are not available to LLPs or individuals. And the other sting in the tail is that property companies are largely excluded from super capital allowances. There's one or two exceptions, which we will cover, but it was a policy intention to deny property companies from benefiting, as they have excluded a trade of leasing, and property companies' entitlement to allowances is because they lease the plant and machinery. So they are going to be denied most of these super capital allowances, with the exception of communal plant in communal areas to multi-let buildings, and we'll expand on that. This seems particularly harsh given that in the last 12 months, property companies have taken quite a toll in terms of rent collections and being denied for a long period, the moratorium on rent collection. It seems a very harsh decision to exclude property companies. And also, there is now no tax incentive for green plant in buildings, just normal capital allowances. And again, it would have been a good policy decision, in my view, if there had been tax incentives for fire safety incentives on the back of Grenfell, in terms of all the cladding that's going to need to be replaced, but only normal capital allowances will apply. The other sting in the tail is the planned increase in corporation tax rate to 25% in 2 years' time. And the message that the Chancellor is saying is invest now, build up capital allowances losses. If you have excess capital allowances, you can carry those forwards to mitigate against a higher 25% corporation tax rate. The other less positive news is the annual investment allowance, which is available to everyone, individuals, companies, LLPs, is currently set at £1 million. Treasury have said that will reduce to just 200,000 as of January 2022. So, it's a good time to invest now. It'll be less positive for individuals, LLPs, after January 22, unless you can benefit as a company from the super capital allowances. The other sting in the tail is that the ability to carry back losses is denied to property companies. So if you are a property investor, please do not switch off in disgust at this point. You are still entitled to other generous capital allowances, which we will be explaining. but largely the benefits of these allowances are going to apply to trading businesses, such as trading, nursing homes, hotels, pretty much anyone who carries out a trade, other than property investors, other than people who lease plant and machinery. Now, here is the problem that pretty much every country is facing, and it's a nice illustration from the Sun newspaper. This is their view of Wembley Football Stadium if it was representing the 2.2 trillion of UK national debt. And this represents how £50 notes stacked up would appear. So clearly, it's a huge problem that we have, that all countries are facing, and the plan to get out of it is through investment and by stimulating the economy, as governments historically have done in the past, by having a generous capital allowances regime. So in this webinar, we're only talking about very plain vanilla tax planning along the lines that the government, pretty much all governments, have encouraged individuals and companies, tax-paying entities, to invest in the UK economy. This is a slide from the Red Book, which, if you're a tax advisor, is known as the well-read book. If you're a politician, it's probably the unread book. And what is quite interesting, there's huge debate by the general public about large companies avoiding tax. And by that, what they really mean is avoiding corporation tax. But if we look at corporation tax, it's a relatively small number in terms of total tax collection. So currently it's in the order of about 45 billion that's collected in corporation tax, out of 700 billion of the mainstream taxes. And I think the plan here is, look, the big tax collection comes from payroll taxes. And if companies are encouraged to invest, they're more likely to employ people, they're more likely to pay more in terms of those payroll taxes. How does the UK compare? If we do have a 25% corporation tax rate, it will impact on the UK's global competitiveness. But you'll all be familiar with the US President's, Mr. Biden's, proposed reforms to corporation tax rates. So I think it's fair to say that the trend in tax is for generally higher corporation tax rates around the world, which does mean that claiming capital allowances, claiming investment allowances has probably never been so important. That, you know, if you want to shelter future planned tax increases and help the economy, invest in plant and machinery, claim the allowances to which you are legitimately entitled. And we've done a little bit of modelling here, looking at two companies, one which is frequently in the news, Amazon. And despite having a huge turnover in the UK, it does pay relatively little corporation tax. Now, there's many reasons for that, and it's not as simple as you'd imagine from reading the Daily Mail. They do clearly invest considerably in the UK economy. Now, what we've modelled here is the impact of super capital allowances. And we did some very crude calculations just from their published accounts, and we would guess roughly that currently each year they're claiming something like 29 million of capital allowances. But with the introduction of super capital allowances, instead of claiming 29 million, we estimate they'll be claiming something in the order of 211 million. So that will have a dramatic impact for a company like Amazon if they continue to invest at the same level or even increase their investment. Similarly for the national grid, you don't hear about that so much, but it invests substantially in plant and machinery, to the order of it spends something like 4.5 billion on plant each year. And previously, we estimate that each year they'd be claiming something in the order of 824 million of allowances, but with the super capital allowances, that could increase to something like 6 billion. So quite dramatic in the next 2 years. Clearly, there's a lot of the economy is much smaller companies than these, but it should still have quite a dramatic impact for companies, provided they do invest. Now, what's changed pre-budget and post-budget? There's no change to decontamination allowances. These still remain the most generous allowances and probably the least claimed. There's 150% tax relief for decontamination expenditure incurred by companies. The annual investment allowance, currently no change other than the planned reduction that we mentioned. The general pool, previously you would write that off quite slowly at 18% on a reduced balance basis. In certain situations, you can now write off 130% all in the first year. And for integral features, these were previously written off very slowly. You can now write off 50% in the first year, with the balance written off at 6%. For things like repairs, there's no change that you'd normally follow the accounts treatment for repairs and get an immediate write-off for any repairs expenditure. Freeport's clearly a big change, and the loss carryback if you are a trading business. What are the key points? Some trading companies have delayed some of their purchases. The effective date for the super capital allowances was 1st of April 2021, and contracts needed to have been signed after 3rd of March 21. So there was some planning around the start dates of expenditure. You had to be quite careful. There was quite a lot of anti-avoidance legislation. So be a little bit careful around the implementation date of claiming these new allowances. And the other thing to be aware is the super allowances only apply to new plant and machinery. So if you buy second-hand equipment, you'd just get normal capital allowances. HMRC Treasury have indicated that if, say, a hotel company with a trading hotel business, if they were to buy a hotel from a developer, provided that hotel had not been used, then super capital allowances should apply. And the one area that property companies may benefit from is claiming super capital allowances for communal plant, things like lifts, central heating, central air conditioning plant in communal areas. We are awaiting some guidance from HMRC, which, despite this allowance being announced more than almost 2 months ago, that guidance is still not issued, and HMRC don't even have a date for which they will provide that guidance. That is quite disappointing. And we also understand that landlords in some situations may be able to claim capital allowances if they make a capital contribution to, say, a tenant's expenditure. But again, we are awaiting detailed clarification and guidance on that point. So let's have a think. How might it work for a property company? So what we can say with complete assurance is a property company will not get super capital allowances for plant in tenant demised areas, unless maybe through the capital contribution route. But they should be able to claim plant and machinery in the core areas, things like communal lighting, communal lifts, but only if it's a multi-let building. And the reason being, if you've got a single tenant, then you are leasing all of the plant in the whole building to that one tenant. So this opportunity will only apply in multi-let buildings. And some tax inspectors take differing views in terms of what is communal plant, and we may need to segregate expenditure to quite a lot of detail in communal areas. Hopefully we get some very clear guidance. Hopefully they're going to be pragmatic, and if you've got landlords' chillers on the roof of a building, that they will accept that falls outside the tenant's demise and is communal plants. Hopefully they don't require pedantic assessments to exclude the chillers on the roof, but allow you the pipework and the ductwork within the clearly defined communal areas. Let's hope not, and hope for that some pragmatism and common sense will apply. But it is strange that it's nearly 2 months and that guidance has not yet been issued. You will need to consider structures quite carefully to benefit from the super capital allowances. And we are, as a firm, looking quite closely, particularly at PropCo, OpCo structures. And you may, in some situations, want to incur relatively more expenditure in the OpCo. If the OpCo is carrying out a trade, the OpCo will then be able to benefit from the super allowances. However, that's only worthwhile if the OpCo is going to be profitable. And if all the profits are going to be in the PropCo, you may make a commercial view that it's better just to claim normal conventional allowances in the PropCo. But with things like hotels, things like nursing homes, maybe even serviced offices, you probably need to have careful consideration about which entity is going to incur the expenditure. But just bear in mind that these super allowances are only going to apply for 2 years, and most likely, if the Chancellor at that time thinks they've done their job, then they will cease. Let's look at a case study, an office fit out. So let's imagine, say, a construction company has a leasehold interest in a building, and they spend 5 million fitting out their office, and a specialist segregates the expenditure and gets 2 million on things like petitions, carpets, desks, and so on, and 1 million on special rate plant, things like air conditioning, heating. And we did a very simple calculation just to see what was the impact of the new super capital allowances. Well, pre-budget, the first year tax saving would have been in the order of something like 258,000. Post-budget, the allowances are accelerated and the saving of just under 600,000. So clearly what's happening is allowances are being accelerated, and the multiplying allowances by 1.3 for the super allowances means you actually get more tax savings as well over time. Another situation that we modelled for one of our hotel clients who was looking at spending 10 million fitting out, refurbishing a hotel. The hotel was an operating business, so it would be able to qualify for the super allowances. The property was held in a separate PropCo, so normal allowances to the PropCo, but super allowances to the operating business. And in this instance, pre-budget, the savings would have been less than 500,000, but post-budget, they increased dramatically to the first year saving of 1.4 million. So these super allowances should have quite substantial impact on cash flows where they are applicable. Just to clarify, a quick clarification here. What are the assets that are referred to as general pool? These are kind of defined in legislation and case law, things like sanitary fittings, carpets, fire alarms. I won't read them all out. Demountable petitions. They're typically assets which have a shorter life. And in the UK economy, it's going to be things like machinery, things like equipment, desks. A lot of it will relate to movable assets and movable equipment. And that's where these super allowances are predominantly targeted at helping. What do we mean by special rate? These are typically assets that have a longer life, things like lifts, hot water, heating, most of the electrics, things like solar shading, and even thermal insulation. So these are the assets now that if you qualify, you can write off 50% in the first year, with the balance at 6%. You can still also claim the annual investment allowance. So companies have a choice now of how they segregate expenditure. Little case study here that's not on super capital allowances, but just to show the value of normal capital allowances to all tax-paying entities. And we were approached fairly early on in the Corona period to help a leisure business. They had, prior to Corona, a very successful leisure business and had paid about $500,000 on account for corporation tax based in their successful trading businesses. Then clearly they had to cease trading completely, and it was really harsh for them. And they reached out and said, look, is there anything that you can do to help us reclaim some of the tax that we've already paid? And we looked at the company, we looked at the accounts, we looked at the tax returns, and very quickly we identified that they'd carried out a fairly recent building project, but they'd missed a lot of allowances. And the reason for that was their builder's invoices just said building works as agreed, as stage payments. The detail was not there, and their accountants, understandably, because they'd not been provided that detail, had not claimed all of the allowances they were entitled. We visited the site, we made assessments, we got records and costs that were available. We put together a detailed analysis and identified an extra $4 million of allowances. And the client received a repayment of tax of $300,000. Plus, that client will get future capital allowances savings going forwards. So it has a significant benefit. So we've been doing quite a lot of work in this area during the Corona period to help businesses that were successful that have been facing hard times. This is completely legitimate tax planning. We did a very detailed report that was disclosed to HMRC. The accountants included the analysis in a revised tax return. HMRC processed the repayment within about 6 weeks. A second case study, again during the Corona period, which actually arose from a webinar like this. Somebody was listening, hadn't appreciated that there were special tax incentives in the UK for land remediation. And the background to this was it was a property developer that had been doing a large mixed-use development site, spent about 800 million on construction, and some of that was on land decontamination. Now, interestingly, this client was advised by a Big Four accounting firm, but despite them having in-house capital allowances expertise, nobody had flagged that there was contamination on site. And the invoices that those accountants had received, again, just said things like excavation, earthworks, substructures. So it was not readily apparent to the accountants that this type of decontamination had been incurred. Now, there were horrible stuff in the ground, like asbestos, even cyanide. There were services diversions as well. And by working with the contractors and their surveyors and scrutinising geological reports and surveys and making our own assessments, we identified 14 million of expenditure that qualified for land remediation. Now, in this case, the client was loss making, and instead of claiming these allowances, you can share some of the benefit with HMRC, and you're entitled to benefit from 2/3. And they got a cash repayment from HMRC of just over 3 million. And that came from somebody listening to one of these webinars. And clearly, these are big numbers. We work on much smaller opportunities, and even any saving, particularly in the current climate, can be very helpful to businesses in terms of cash flow and viability. Another example, again in the Corona period, we were approached by a private school who'd bought an office in London. They spent 10 million buying the building, and they refurbished it for about 2.5 million. And they had been successful pre-Corona, had been paying corporation tax, but again, they had to close for most of the Corona period. And again, allowances had been missed. So their accountants hadn't claimed anything on the purchase of the building, and they'd only claimed some very modest allowances on things like furniture and desks, which were clearly shown on invoices. So again, we visited these buildings, suitably masked and Corona protected, and we identified 2 million out of allowances on the purchase, and we got 2.5 million. Basically, all of the refurbishment qualified for different types of allowances. And this client got an immediate repayment of tax of 400,000 plus normal capital allowances going forwards. All of these case studies pretty much apply to most entities, with the exception of contaminated land, which only applies to companies. But the example of the leisure company and the school here, that would apply if they were structured as individuals, LLPs, or corporates, as long as they were structured as a tax-paying entity. You might be thinking, well, this all sounds very obvious. Governments, hand out these incentives. What's the complexity? Why do we need to listen for 1 hour to a webinar? And the practical reason is it's hard. So on one hand, the Treasury encouraged these allowances, but on the other hand, the tax legislation makes it quite difficult. And the tax legislation is almost written as though you get an invoice for every single asset. Now, clearly, when you buy a building, in this example, we've got someone buying a building for 5 million. In this example, the seller was a non-taxpayer, so it could have been a charity, it could have been a pension fund, or it could have been a property developer not entitled to claim capital allowances. And where this applies, where you're buying a building from someone who has never claimed allowances, then there won't be a tax election in the contract. There won't be a capital allowances figure in the contract because no one's claimed these allowances. And that's the practical problem for the property lawyers and the accountants, that they are not valuers. They do not segregate plants. No lawyer or no normal accountant, unless they have capital allowances specialist inside or helping alongside, they will not segregate these figures. So in many cases, capital allowances have not been claimed when people buy buildings. or people have just accepted a low capital allowances tax election. So that's the first reason. And the second reason is when people carry out building projects, they very often only see, or their accountants only see, a pile of meaningless invoices. And that makes it very hard for the accounting and tax profession. As if you're a property person, you will know that there are normally things like bills of quantities, price schedules of works. There are some cost breakdowns available. Sometimes there's just an agreed figure, in which case a capital allowances specialist can help to segregate all the costs. So it's not rocket science. It's a very practical skill. There are various capital allowances around. When I started doing this 30 years ago, kind of all the specialists knew each other. Now you may be aware of each other, but you may not know the individuals. But for this reason, we still find that probably less than half of companies, less than half of individuals properly claim the allowances. And in some cases, they overclaim. So don't do that either. Who can benefit from normal capital allowances? It's the tax-paying sector. And allowances go for fixed plant, they go with a land interest. But individuals, pretty much any tax-paying entity can claim allowances. So the triggers are economic activity. So if you buy a building, you may have an entitlement. If you carry out construction expenditure, you're most likely to have an entitlement. And the great thing about this area is it's not a scheme, it's not something artificial, it's not like doing contrived stamp duty planning. These allowances are given on the back of genuine commercial activity. And if you miss allowances in 1 year, then provided you still own or still use those assets, then you can normally claim the missed allowances in a current or later period. So, if you've been listening and you think that maybe one of those case studies is applicable, then in most cases, you can claim the allowances that have been missed in a current tax return. There are some time limits for contamination expenditure, but you can normally go back 4 years, sometimes 6 years. I don't propose to read through this slide, but it illustrates who can benefit from allowances. The only one that property developers can really benefit from is the decontamination allowances. Occupiers can benefit from pretty much everything, as can property investors and offshore investors, with the exception of the super capital allowances, apart from those situations that we covered, such as communal plants. And interestingly, offshore investors, they were denied contaminated land relief previously because they were taxed as individuals, but they are now taxed as corporates, so they can benefit from decontamination allowances. Individuals can benefit from normal capital allowances and structures and buildings allowances, which my colleague Richard will cover. But the tax-paying sector are not able themselves during their period of expenditure, period of ownerships, to benefit. But they can pass on allowances to tax-paying investors. How do you get good results with capital allowances? This is something that we're asked quite a lot. And our best clients are those that talk to us before they buy, before they carry out major building works. Where it's kind of unfortunate is if people don't talk to us until after they've bought something or after they've fallen out with their builder. It can be a bit more tricky. It's still worth considering, but it's a lot better if you're working alongside a specialist at the stage just where you're kind of agreeing heads of terms. And if you want a good result, if you're buying, put some simple but effective wording in the heads of terms. In the contracts, have more detailed wording. So we try to work behind the scenes with our clients, and I'm a great believer in very simple but clear wording in offer letters and heads of terms with more detail in the contract. And if you want to read a tax case where it kind of went wrong, if you Google this reference on the slide, Gley House versus HMRC. And I would say if you are a property lawyer or an accountant and you don't have access to a specialist, you may want to limit your PI liability with a statement, something like this one. And we are starting to see increasing numbers of claims, mainly against property lawyers, where they've made statements about capital allowances, which have later proved to be not quite correct. And this is a tricky area. I have huge sympathy for property lawyers, huge sympathy for tax advisors. Capital allowances is an area that changes a lot. And unless you've kind of got the practical surveying, the property knowledge, it's quite hard to marry it up to the tax legislation. I've termed this situation here a golden scenario. It's not because I'm in my golden years. I plan to keep doing capital allowances for some time yet. But what I mean by golden scenario is it's a golden opportunity. And if you have a fact pattern, something like this, then you're likely to get quite high levels of allowances. Now, let's supposing you're buying a property right now. And one of the things that you have to do is look at the historical position and forensically piece together what the capital allowances position was previously. Now, in this fact pattern, the previous owner was a pension fund, so not entitled to claim. And the owner before that was a property developer who held it as trading stock, again, not entitled to allowances. And even though this may be a very old building, no one's been entitled to the allowances. So if you're buying it now, you are completely legitimately entitled to claim allowances for all of the landlord plant that's in that building. And the price that you pay for that building is regarded as reflecting the age, the obsolescence of that plant in most cases. So you would just apportion the price paid between the land, the building, and the plant and machinery. So there can be very substantial allowances, and on something like an office, you might be looking at allowances on a third of the price. You may also be able to benefit if it's been relatively recently constructed from structures and buildings allowances. This second scenario, silver scenario, my children keep reminding me that my hair's very grey now, so this may be more applicable. It's less attractive than the golden scenario, but in this example, and it's quite a more typical example, the seller has claimed allowances, and they're asking you to sign a tax election in the contract for a low figure. So in this example, seller claimed $1 million. Seller wants to keep all of the $1 million that they've claimed or can continue to claim and just give the buyer £1. This is a very typical scenario. And a lot of clients, a lot of advisors would think, that's it, you just claim the elected figure. However, the tax legislation changed in 2008 for capital allowances, and after April 2008, there's a wider definition of plant. So that tax-paying seller could not have claimed allowances for general lighting, general power, cold water, solar shading. So that £1 tax election is not binding on those assets. So without any cooperation in this example, the buyer can make a top-up claim for those allowances that the seller could not claim. The extra allowances may be in the order of an extra 10 to 15% of the price that's being paid now. So look out for this situation. It applies still quite often, but it only really applies where the seller has owned it before 2008. I think this is my final slide before I hand over to Richard. Let's imagine you have the great good fortune to advise these clients, and you are instructed by HRH Woke, and she wants to claim as many capital allowances as she can legitimately from the UK Treasury. And clearly, the first thing you'd have to do would be to piece the history together. And you may find that Mr. Biden here has claimed no allowances. Sleepy Joe, he completely forgot. But Mr. Trump, Mr. Sharpness, Mr. Goldleaf, he's claimed 20 million of allowances. And then you'd probably ask a few more questions in the CPSEs and maybe separately from the CPSEs. And you may find out that Mr. Biden, the reason he claimed nothing is because Trump insisted he sign a £1 tax election. So on the face of it, no allowances for Meghan. But again, you can see from the dates that you can apply the silver scenario logic. So Meghan would be able to make a top-up claim for Joe's unclaimed integral features. And you'd want some wording in the offer letter, heads of terms, most probably to get Joe to cooperate that he would pool or claim those unclaimed allowances and transfer them across to Meghan. So that would be the first opportunity. Second opportunity is probably, Biden really didn't like any of Trump's fittings. His wife wanted all the toilets replaced. So they probably, Mr. Biden has spent money during his ownership of that property. And if he hasn't claimed those allowances, you would most probably want him to pool or claim and transfer those allowances as well. So I think and there are other opportunities as well. I don't really have time to go through them all. But the key point is for properties, it's very important to consider the facts ideally early on and to have a capital allowances specialist behind the scenes working closely with your property lawyer. Property lawyer is very good at drafting clauses, much better than we are, but we can apply the practical skills alongside to help them. And if you do consider the allowances early on, you're much more likely to get very substantial allowances. A lot harder if the contract is silent. I'd like to thank you for listening so far, and Richard will now be concluding the seminar. We will, at the end, try and answer some of the questions. Please stay with us. Richard is a very good presenter, but thank you for listening so far.
Thanks, John. Hopefully you can all hear me. If not, please let me know and I'll try and sort it as we go through. So as John mentioned, I've got a similar background. I don't quite boast the experience of him, having only worked in capital allowances for 4 years, but I am tax qualified, so hopefully I do know what I'm talking about now. You may have heard him talk about the Structures and Buildings Allowance. This was introduced in the Finance Act in 2019, and it's designed to give a new tax relief on allowances which don't typically qualify for the plant and machinery that John was previously mentioning. So you can now get tax relief on structural and building works. This was initially introduced at 2% per annum on a straight line basis, which is obviously less generous than the 6% and 18% for integral features and general pool. So the government kindly increased this to 3% from April last year. It does apply to demolition, enabling and construction contracts, but the key point is they have to be entered into on or after the 29th of October 2018. Otherwise, you don't get them. It applies to commercial properties only, so residential properties don't get it. Other restrictions include prisons, student accommodation, whether that's university accommodation or boarding schools, and the legislation does have specifics as to what accommodation is defined as. Armed forces, residential is also excluded, but it is worth noting that you can claim SBAs on care homes. There are no clawback on SBAs if you sell an asset. However, and this is a big difference, Unlike plant and machinery allowances, once you sell an asset, it is affected for your capital gains. So your base cost for capital gains is reduced by the amount of SBAs that you've claimed. So this is going to be an increase in your capital gains, whereas the plant and machinery allowances John previously spoke about don't affect this. You also heard John mentioning the mechanism to retain allowances via the S198. This doesn't apply to SBAs. You cannot keep them. So once you've sold your asset, that's it. You don't claim them, and the residual balance of allowances goes to the new buyer. And in order for the new buyer to know how much they're entitled to claim, you have to pass on what is known as an allowance statement. And this details the date of the construction contract, the quantum claimed, and other information. But as we all know, things do get lost. And when buying a property, information can be hard to come by. So I might be a bit pessimistic here, but personally, I don't see in 15, 20 years' time an allowance statement being readily available from the first time they were brought into use, because every time you carry out some new refurbishment works, you need to do a new allowance statement. So it is a bit of internal hassle, but it needs to be done. So another key point is that the SBAs are not an absolute tax saving. They are more of a cash flow benefit. So even when we identify SBAs, we do advise that you speak to your tax advisor or accountant to see whether they are actually worthwhile claiming. Similarly to the plant and machinery allowances, you have to hold the property as investment. So it will be a fixed asset in your accounts rather than trading stock. But this doesn't mean that you can't benefit if you buy it from a developer. So if a developer builds a building which is applicable for SBAs, the new buyer, as long as it's new and unused, will be able to claim structures and buildings allowance on the price paid for the property, less land value, and then the other plant and machinery allowances. In the new budget, there was also the introduction of free ports. Whilst they're not new to the UK, we did have 7, I believe, between the 1990s to 2012. We haven't had any for the last few years. I think there are 80 odd across the EU. And so the UK has now said we will have some, and 8 have been announced. They're designed to encourage investments and create jobs and trade in areas which would typically struggle to achieve this. So you can see from the list there, Plymouth, Liverpool City, East Midlands Airport. And some studies have argued that it will bring £9 billion to the UK economy and increase jobs by over 150,000. But as I'm sure you've all seen in the news recently, the denial of, imposing tariffs on these free ports to the new trades with 23 countries doesn't do it any good. 8 have been announced so far, but there are meant to be some more announced in future years. But the details of the final legislation are still to be released. Obviously, free ports benefit from tax benefits, which is another reason people are against them, because the argument arises that it does just create mini tax havens, and the EU has come down and said they are going to focus on stopping some corruption and money laundering across their 80. But thankfully, that doesn't apply to capital allowances, and the capital allowances is pretty good for free ports. So I'll go into those now. As you can see here, there is an increased rate for the SBAs. So as I said in the previous slide, it's 3% per year. But if you're within a free port and you've got a qualifying building, it's actually at 10%, which is obviously quite a big increase. Additionally, there is 100% enhanced capital allowances for both general pool and special rate pool investments in new and unused plant and machinery. And this is up until the 30th of September 2026. As you can see, property companies will be potentially denied, but HMRC are yet to confirm this. As I said, this is uncapped, and so 100% is a big increase compared to the 18% or 6% it would be if you were disregarding the super capital allowances. There is obviously additional relief such as SDLT and business rates relief. And then they do plan on bringing in April 22 national insurance contributions relief for new employees. And that will either be, as I say, from April 2022 or when the Freeport tax site is fully designated as a tax site. Super capital allowances are also available in Freeport. And I know this sounds a bit odd considering I've just said they will benefit from 100% general pool and special rate pool. But remember, the super capital allowances is only until April 2023. So you can claim the 130% general pool instead of 100%, which is obviously a 30% benefit. So common misconceptions. I know we're running out of time, so I will try and breeze through these. John's covered quite a lot of them. So we've missed the time limits to claim. This is not true. You obviously have 2 years to file. Well, you've got a year to file your tax return after your year end, and then you can amend a year afterwards. So if you're amending, you can benefit from the annual investment allowance or trigger a tax rebate. If it is past the time to amend, you can still claim, you just won't benefit from the AIA. As long as the asset is used in the trade and you haven't sold it, you can claim allowances on it. And you can go back as far as you like, 1996. As long as you can prove the expenditure has been incurred and you've still got the asset, you can make a claim. As John's covered, the benefits are not lost on sale. You can retain them with an S198 tax election, although there may be an impact for super capital allowances, but we're waiting for the final legislation from HMRC to confirm this. Again, we often hear it reduces capital allowances gains base cost. This doesn't apply to the general pool and special rate plant and machinery. It is only the SBAs. So it's important that if you're going to claim the SBAs, you do discuss this with your tax advisors, which again is another typical thing we hear our tax advisors deal with this. Normally, a tax advisor will tend to claim items such as computers, furniture, etc. But if they get a lump sum invoice, as John said, for building works, they will either typically say this is non-qualifying, or now they may attribute it to the structures and buildings allowance. But it is worth noting, once it is attributed to the SBAs, you cannot reclassify it to general pool or special rate plant and machinery. So it's always in your best interest to say it's non-qualifying if you're not sure, because you can then recategorize it in a later tax return to general pool or special rate. This slide I won't particularly focus on. It's just a very key tax relief segregation. So obviously at the top, you've got 150% contaminated land relief. At the bottom, your SBAs at the slowest tax relief, and then obviously exclude expenditure of land costs and SDLT, which are just too remote for capital allowances purposes, so can't be analysed. Post-corona impacts, we would expect, and we are seeing, landlords are carrying out more strip out and reinstatement works, which would have usually been covered. And there's also greater landlord capital contributions. So instead of imposing a rent-free, a landlord is more likely to say, we'll give you money to your fit out, because they're going to benefit from these super capital allowances. So whether you're a landlord or a tenant receiving a capital contributions, it's always important to speak to a specialist to ensure the wording is in the heads of terms and then the agreement for lease to benefit you in the best way. Landlords are obviously also going to carry out more works to enhance buildings' communal areas and tenant spaces, not only because they need to entice people back into the office, but because of all the safety regulations that are going to have to be implemented. So it's important that these are done and landlords are going to do it. So it's good news for capital allowances. Often missed opportunities by tax agents. So it's quite often that in a sale and purchase contract, there will be a tax election, and too often these are just accepted as the correct figures. Obviously, John's covered these in instances. So someone may have claimed allowances but not been entitled to integral features. So they've put in a tax election and the new buyer hasn't realised it and it's just been accepted. Again, there may be an opportunity to top up. It doesn't harm to speak to us and we can see if there is any additional scope or not. Earlier acquisitions or construction expenditure, people say it happened 10 years ago, so there's no point claiming. We've covered this. As long as the asset's still in use, it can still be claimed. We just need to be able to see that the amount of expenditure has been spent and we can do the rest. Another one, mixed ownership structures. So pensions are not entitled to capital allowances, but if it's mixed ownership, it's often missed because the individual is entitled to capital allowances on their share. Again, CPSE responses, they often say not applicable to capital allowances. So capital allowances kind of brushed under the carpet and they're left alone. This happens a lot because people just don't have the information. So they just say, not applicable and nothing else is said. if this happens, you should definitely inquire more, because the chances are there may be something. So keep a lookout. So how Lovell Consulting can help. We will happily look at tax computations or discuss any recent acquisitions. We don't charge to have a look at computations, and we can quite easily assess within a short period of time to see whether there's an additional scope. We can then provide a proposal which will outline our scope, the likely fee, how we work, and just our overall process. Again, we don't charge for any of this, so there's no loss in contacting us to say, is there a chance here that we can claim allowances? We're very happy talking to HMRC if that ever happens. Our team includes 2 former HMRC valuation officers, which is something that no other firm has. We're also very happy, as John said, to provide tax selections and wording for sale and purchase contracts in order to benefit you in the most beneficial way. So that concludes our presentation. I'll just see if we've got any questions, and then I will let you go on your way. First one, will a copy of the slides be made available? Yes, we will email the slides out to anyone who wants it, and CPD. We will also email out a copy of the answers to all the questions, because I'm not sure I'm going to be able to get through all of these in time. So one of them, so are you saying in an OpCo-PropCo structure, only the OpCo can claim the super capital allowances? Yes, apart from in the common area plant in multi-let buildings. What else have we got? Is there any restriction on claiming the super deduction if it generates losses in that trading entity? No, there are no restrictions. As John mentioned, you can create a loss, and now due to the budget, you can carry these back 3 years as opposed to the previous 12. Any residual losses will then be able to be carried forward. Is there going to be a new allowance for ECAs? So enhanced capital allowances were initially brought in for energy efficient plant and machinery. They were abolished in April 2020. Currently, there isn't a new allowance for these, but the super deductions have obviously taken over. But once these end in 2023, I wouldn't be surprised if there was something to replace them because of the kind of push for greener technology. We do have quite a few more questions, and I'm conscious that we are over time. So I'm going to say we will write the answers to these and email them around. So thank you very much for your time. If you do have any questions additional to what have been put in the chat, please email them to us. We're also happy to pick up the phone and talk to you and discuss any opportunities that you may have. So thank you very much for your time. Have a lovely day, and bye-bye.